It's very important to me to make the world a better place. I'm very human focused in a lot of different ways, in who I serve, thinking through how people behave.
My guest today is Kate Brodock. She is the founding partner of W Fund, a VC firm investing in early stage founders led by amazing women and underrepresented founders. What excites you the most working with early stage founders?
Literally working with the humans. I get the most joy working with the founders at the human level.
What exactly is the difference between being a founder and being a CEO?
You have to grow into a new person if it's going to be you. Or you had to have done it before, something like that. You have to get those added huge amount of skill sets. If you have a startup, you're having somebody invest in you on your singular idea. When you're fundraising for a fund, you are actually investing in that GP, and you don't know what those investments actually are going to look like. I do a quicker skim through. I look for that story, but the important thing is the money story.
Hey, Kate, welcome to the show. How are you doing today?
Great. I'm so glad to be here and sit down and chat with you.
Amazing. It's an honor. It's a privilege to have you on the show. So thank you. Thank you so much for the time. Every single time, anybody that I ever have on this podcast or I ever will have a podcast, so I always want to start with one particular question. And that question is, what's the context of your life? And who is Kate? And what is your story?
Wow. That's a big question. The context of my life, I would say a couple of the big themes in my life are it's very important to me to make the world a better place. It's a pretty big driver. A lot of that involves humans. I'm very human focused in a lot of different ways, in who I serve, psychology, thinking through how people behave, that type of thing. I really just do think that's a big contributor to the world in every single aspect that we can think about. I've always gone fast. I've been working in the past couple of years on slowing down a little bit. I was a girl who always wanted to be on to the next step, on to college, on to the post-college, on to all the stuff very quickly, boom, just like that. I'm working on that because I would say there are some benefits to that and there are some negatives.
Okay.
Trying to figure out how I can sort of maintain that speed, but also maintain my sanity. And then I think a little bit more tangibly speaking, I have been really involved in the tech and innovation spaces. Almost on accident. I sort of popped into it after I graduated from college and haven't left. I'm someone who does not have a linear path at all. I'm sort of got my stuff over here, and it all makes sense to me. Sometimes it doesn't entirely make sense on paper, but I feel really great about what I've scooped up and put together. And so, yeah, those are a couple things.
Good to know that. Okay. Thank you for sharing all of that. There are two questions that I want to start us off with. The first one is why you're doing whatever you're doing and what exactly is that you're doing. And how big is your day, by the way? Because you're doing a ton of work. Just tell us all of that.
This is where it looks like a wandering a lot path on paper, and it actually has a lot of overlap. So everyone always asks me how much time I have, and I'm like, I have more time than it seems like I have. So what is it that I'm doing? I have spent a lot of time in my past working with, on behalf of, in support of whatever early stage tech founders, particularly women and underrepresented tech founders globally. So I've done that in a lot of different capacities. From an organizational and community standpoint, I've run several large global organizations focused around women in tech. I have mentored and advised through various different programs. I've spoken and done thought leadership pieces. I've worked one-to-one, and in the past probably decade, I've added on investing to that. I do both angel investing and I also run a VC fund. So my world is directly in that space in several different capacities. I sort of always have, as I mentioned, some parallel lines going on, and they are sort of in support of each other. So I run a large organization called Switch. We have a founder focus that has settled in on the idea of, number one, capitalization. So our sort of North Star is how do we get these early stage founders capitalized And specifically for women founders, if you know the stats, the traditional sort of VC funding in your capital stack is a really small percentage. For those in the audience who don't know, in the US, it is under 2% of VC funds go towards all women teams. And I think it's something this year around, or last year around 16 or 17% with like dual male, female founding team. So really focus a lot on building out capital stacks, getting ready for investment, and also leadership component. So this idea that in that early stage, I'm sure everyone in your audience can feel this, there are founders who have varying levels of leadership backgrounds, management backgrounds, running a company. And this is really when you become, all right, I've got an idea, I'm going to start something. So you're a founder and you've got to become a CEO. And so we focus a lot on that from a leadership standpoint. We also do a lot of empathy training. We think empathy is like a very important skill set to have, and actually we do a lot of that on the investor and corporate side. Our system really needs to have a lot of empathy built into it. And then we train women angel investors, have an angel group. I think it's really important to get new people writing out checks. That'll help the whole system. And then we have our VC fund. So long sort of, and then I do, again, some mentoring with different programs on the side as well. So all sort of like my world is early stage tech startups and gender and representation and stuff in the innovation space.
Okay. I got a ton of questions on that. But I want to start us off with what excites you the most working with early stage founders? Because that's probably the messiest part of this entire ecosystem. It's just like,
It is.
Yeah. So like, what excites you the most about working with early stage founders?
Literally working with the humans. I am one of those people that I get the most joy, not out of sitting down and busting out a pricing strategy or that type of thing. It's very literally working with the founders at the human level of these are people running this firm. They are people with all different mindsets and backgrounds and viewpoints. They have varying levels of resources around them, whether it's monetary or human resources, and really working with them to set them up for success to actually run and grow that company as best that they can as humans. That's honestly probably my favorite part. I've always said to people, I was like, if I could just sit back and be paid and like literally just have open office hours and do that, I would be extremely happy. Just come, everybody gets an hour slot. And that's my all-time favorite part. And then seeing that through and seeing founders who are successful or founders who might fail once and go back at it again, and it's a lot of the little stuff in there too. As an example, I had a great conversation with a new woman founder a couple of weeks ago, and she was really on the first meeting. She was questioning whether she should be the CEO. I jumped right into it and we had a great conversation. And she walked away and she felt so much more confident about her role and feeling like I am the right person to be here. Like that's huge. It's huge. So little things like that.
What exactly is the difference between being a founder and being a CEO?
Some overlaps. I would say some of the differences are founder. You're focused on putting all of the pieces together and resourcing this idea coming. There might be one or two other people floating around. There might be a co-founding team. But like the focus is the thing, the product, the solution. We got to get it going. We got to get it in the hands. We got to build the tech, like all of that stuff. As you start to grow, you have added layers of responsibility at that point. Number one, all of the things that come with running a company, right? You might get investment. You have responsibility for that investment dollars. You have increased levels of relationships with things like investors and customers and that type of thing. And then you might build your team. So now you have other people coming into your company, all sorts of stuff in there. You have to figure out your own leadership style. You have to understand how to manage and delegate and how do we do things like run meetings. And the system just becomes larger and it takes a different skill set to be able to wrangle that and organize it, and most especially and importantly, be able to act within that system and continue to grow on top of that. And that's really different from when you're just starting out and you've got this, like, essentially it's a smaller thing at that point. It's not so complex. So that's sort of, I think, one way to kind of look at that. And you got to have a lot of tools in your toolkit to be able to start handling all those different pieces. That's kind of one way that I think about leadership is like the tool set that you need has to continue to grow. And it's not one particular tool set.
So I want to just take us back to your operating days, when you were working in startups as a COO and a CMO, and I think as a startup operator, the title doesn't mean anything just because you're doing like pretty much everything, right? So
Jack of all trades.
Exactly like that. So what were the 3 biggest takeaways from your days, in startup, like operating and managing and growing those teams and companies before you started doing whatever you're doing today?
I think developed is this idea of maybe not quite what makes a good startup team, but being really thoughtful about how you think about a startup team. And I'll give you an example. And the different types of people, right? So I'll give you an example. I was the CMO for a company, AI-driven company, several years ago, and newer founders, it was a co-founding team, and one of them out of, big banking, had been sort of like been surrounded by, sort of like aggressive banking mentality and that type of thing. And I remember having this conversation with him once, and we had this great senior web architect in the company. And I remember having this conversation with a co-founder, and he said, so-and-so head architect, gosh, I want everybody to just think outside the box. And I wish so-and-so would think outside the box for a bit. And I sort of stopped him for a second. I said, well, hold on a second. First of all, if you had an early stage startup team where everybody's thinking out of the box, like, you're going to have chaos. And I said, this employee of yours is highly reliable. Like, you exactly what you get. Structured, is bringing in processes in place and that type of thing. You're right. He's probably never going to think outside the box, but he's going to be able to translate your thinking outside the box into the product. So it's one of these things where that I would sort of see that similar things happening inside these companies. So just really thinking about this idea of like what makes a good either startup, early stage startup employee or team or characteristic or something like that, right? And then putting them all together because it looks different than, if you throw it into a group inside some large corporation, or it could look similar, but so that I always thought was interesting. Definitely had my fair share of good and less good leaders and bosses. And I think this is for everybody, right? This is not a startup thing. But again, like back to our conversation about founders, I think in particular, the startup space in particular, you have people starting companies from such a variety of background that I don't think you get when you're talking about like corporates, right? You have a little bit more of pathways in there. And that plays out in leadership. I learned a lot there. This is sort of obvious, but I think it's important when you talk about experience and background. This is where I got exposed to early stage startup growth, definitely capitalization. I sort of jumped in on the fundraising side, even though it wasn't my role in several companies. I just wanted to learn and interact. So it's interesting because that, I think, also played into when you talk about this idea of track record as an investor. I believe firmly, and this could be VC or angel investor or whatever, is this idea of track record can be really different and strong when it's not an investment track record. And I think that's important because a lot of the investing space focuses a lot on that track record thing. I think that's another thing we really have to like reassess
So linking the same question to a question for today, which is three of the biggest problems or area of improvements that you see in founders today.
I'm going to focus this on new founders, so not repeat founders, because obviously, right? So number one is definitely knowledge around fundraising and capitalizing the company. I have seen so many early stage founders, especially if they're outside the space too, if they don't have a ton of exposure to things like just the VC process or anything like that, is this idea of really effectively fundraising from a sales perspective, from a process perspective, understanding the full, really what goes into it, understanding what it means to now have, 6 investors on your cap table that you then have to manage, how reporting structures go, sort of all of that stuff. That whole process is very foreign if you haven't done it before or been in it. And it is such an important process. That's one of the reasons we have focused so heavily on it, because we really see it as this area of, if you can get yourself investment ready much more effectively than just sort of whatever comes at you, you can actually kind of really do it intentionally. You're just going to be so much more successful. And I think that's where you can do a lot of learning from people who've done it in the past or that sort of thing. So I think that's number one. Again, not to, sort of hammer down on this too much, but being self-aware of your leadership capabilities. And it's okay if you're starting out and they're very low, that's all okay. But being very self-aware of how that truly impacts your entire company and being able to iterate on yourself. It's so easy for founders to just be so focused on building and structuring and resourcing their thing. And it really gets deprioritized that they have to do that for themselves too, in order to literally keep up, based on kind of our previous conversation, right? They've got to keep up too. And if they don't, it's going to kick them in the butt. Those are kind of, I think, I would also say that hiring, obviously some people are good at hiring. Hiring can be, I think, a really difficult process too, especially when you're a little earlier stages. You have lower capital resources, and a lot of companies start out with contractors, and it's hard to assess. And then you've got to assess a bunch of different roles. That's always an area where I say to folks, if you have some good people around you who can help all of these things. I'm a huge supporter of get people around you that you can help with all of this. Hiring is one of those things. I think that's a great area for advisors or even investors to really be supportive on, because hiring is tough in early stages. It's hard.
Thank you for sharing all of that. So I've listened to almost all the podcasts that you've been on. Almost all the podcasts, I can't say all of them, but almost all of them, just to figure out okay, but people have already asked you, so I don't want to repeat the same question and make it sound boring or whatever. So I want this particular episode to be somewhat of a masterclass for early stage founders. That's what I love. That's what you love. So I would love to talk about that. Let's talk about your fund. Let's just start from the beginning. What was the turning point for you to just let's just put together a fund? What do you think about that? And I want to know the Twitter story as well. So yeah.
It was a little bit of a duh moment. So I mentioned I had a super strong background, just essentially working with thousands of early stage tech founders in various different roles and capacities. And specifically, again, primarily women tech founders. I had a colleague in this space who'd run a similarly focused organization for over a decade. We'd done a bunch of work together, and we literally sort of said to ourselves, my God, duh, we've been working with this particular set of companies in basically every capacity that it would take to make an investment decision. We've literally written out non-equity taking checks with the same processes. We should be getting some equity in some of these companies. I mean, we looked back at some of the companies that went through some of our programs, and we were like, oh my God, if we had had equity in that company.
What were those companies? Some of those.
Oh gosh, I can't pull a couple of them up. I'm so bad. I'm so sorry. I'm like really bad at pulling the Rolodex. So it was a little bit of that process is we really just said, well, God, we should have done this 5 years ago, practically. So that's how we started. And we also knew we had a lot of strengths that we knew we had. So we knew that a lot of our LPs were going to come from our community. For instance, we had, in addition to obviously having founders in our community, we had just amazing professionals, a really large amount of women professionals. They were all going to be accredited investors. They've been hanging out with us for, 10 years. And so that was also really important to us. And we knew it was a huge opportunity. So in our Fund 1 right now, which we're just about to close at the end of this quarter and start Fund 2, we've got about 60% women individuals as our LPs. Yeah, so they're all worked hard and they've got assets now in their hands and they want to put it to work. It was kind of that dual purpose, and we have ridiculous deal flow. So like we had these awesome components. We've never, ever done outbound once for our fund. It's all inbound. We knew we had these components to make a fund. Once it dawned on us, so to speak, it was a pretty quick decision at that point.
Okay. So just curious to know, as a first-time fund manager or aspiring first-time fund manager, so I have a lot of questions on that. Two-part question. So question number one is, how difficult is it to raise a fund actually compared to a fundraising for a startup? So how much work is that? And where should somebody start? So the second one is, does fund actually do outbounds? Like, is that even a thing?
I would say over half, the majority of funds do outbound. Yes. I think deal flow is actually a pretty difficult thing. If you think, we had talked earlier about this idea that most traditional funds are not community driven. They don't have big communities. It's relationship driven. So you might get deal flow through co-investors and that type of thing, but it's not primarily been this like open door policy so deal flow is something that people have to really develop over time. They have to develop the channels. And a lot of funds, that's what that analyst layer in the larger funds do. They actually go out and they're analyzing the YC and the Techstars cohorts. They're checking out who's graduating here. They're outbounding. They're actually requesting meetings and decks from all of these companies to do assessments. That's how a lot of the larger firms work. That is a fairly common practice. And then, it's obviously along a spectrum, right? So, but yes, on outbound. And then your first question, first of all, they're both hard. Some of the differences that I see. So first of all, some of the similarities. You're asking people for their money for some sort of equity that you are then responsible for. That doesn't go away. However, the line to success looks a little bit different. And what I mean by that is if you have a startup, you're having somebody invest in you on your singular idea, and that one idea's chances for success based on their own assessment, right? When you're fundraising for a fund, you are actually investing in that GP, and you don't know what those investments actually are going to look like yet. You have a thesis, but there's nothing tangible, unless they might have made a couple of investments before. They'll have Fund 1 to look at in our case, but that's why track record has become so important in this space. It's a returns thing. It's like, I am placing responsibility of my money and my diversification in you as a person and your decision-making capabilities. So that's something that I think a lot of investors or LPs in this case have to get their heads around, especially if they haven't done it a lot. So that's one thing that we talked a lot to our LPs about, is just, how to think about that. For us, I would say we also have a lot of newer LPs. So we had to do a basic education on the system. it's more straightforward if you're investing into a startup. And then things like the reporting and the relationships is a little bit different, though it certainly has some similarities. You're sort of doing an ongoing report on success. And it takes, if you think about it, the same amount of time it takes for a company to exit is kind of the same amount of time a fund has to
exit. Yeah.
Until the returns on paper actually become real returns. And then again, I think that LPs in a fund tend to be, they're coming at the problem from a very different perspective. Is LPs in a fund, many of them, it becomes a writing out a check and walking away, right? It's a transaction, it's part of their portfolio, etc. When you're fundraising and so there's usually less of a relationship there. When you're fundraising for a startup, they say, most of the people listening to this will have heard this, but this is like a marriage. Because you're going to be working a lot more closely with those investors. Some might be on your board. Some might just write out the check and walk away and take the quarterly reports, but a lot more are going to be much more involved in your day-to-day or how your company is being run and that type of thing. That's portfolio management. LPs don't really do that. They do it if they start seeing hey, what's up? How's it going? I'm seeing that nothing's happening. But for the most part, it's a much more separate relationship there. And so for founders, I think there has to be a lot more thought put into the who behind it and the relationship that's going to come from it than folks in a fund. I will say there's a little bit of a wave right now of LPs starting, I think it's a small wave, starting to put some pressure on their actual funds much more. And we've seen this in things like the ESG space or the DEI space, starting to say, hey, I actually care about where you're putting your investments now, but that's a very small wave. So those, I think, are some of the big ones. And then it's, the story you've got to tell. My feeling has been the story that you tell, we talk a lot about storytelling with founders, right? The story you tell for a fund is not always as tangible because it's ideas and investment areas and that sort of thing. So getting that story going can be harder. I found it to be harder. And I've done a ton of work on pitching and all that stuff. And I think it's harder to pitch a fund. I do.
So from my experience, it kind of feels like you have a early stage startup and you will always be an early stage startup. It's just you're always pitching an idea, a thesis kind of a thing to almost everybody.
Yeah.
The startup is kind of become we have raised a couple of rounds and now it's starting to get some tangible. We have some metrics. We have some numbers to show for. On the fund side, it's always an idea. Hey, we will do this thing. We will do that thing.
It's right.
It's like that, yeah?
That's another really great point. It's the timeline, right? For a founder, for a startup, you'll have a difference in traction in 6 months.
Yeah.
For a fund, you're well, we made another investment, still got to wait 3 to 5 years.
Yeah.
Yeah. It's I can tell you how the startups are going, but
yeah, it's exactly when you mentioned when you need to show progress for a startup. A couple of years later, you can say, oh, we hit all the milestones, have some traction, kind of
we've grown our team.
Exactly. You have numbers. As a fund, it's just hey, 4 years went by and we just made 10 times more investments. That's probably it. Yeah. So we're just still, yeah.
And the tough thing is, so also when you start to raise, so we're about to raise fund 2 and we still, because we're investing early stage in fund 1, we still don't have, and it's natural, nothing's wrong.
Yeah.
We just still don't even have a ton to talk about in terms of success. We've had some fundraising rounds. We've had markups. We haven't had an exit yet.
Yeah.
And so we were going into fund 2 saying,
same story again.
Check out fund 1. But yeah.
All right, awesome. So the next question that I want to ask you is the next series of the question that I'm going to ask you is around what do you look for in a founder when you make a decision? Okay. So suppose you get a pitch deck in front of you. How long do you actually spend time on it? Like how long you actually spend actual time on looking at it, understanding the narrative? You tell people stories, like you've been teaching people how to tell stories. What do you look for in a pitch deck the moment somebody sends it to you? So what do you look for?
Okay. This is a great question. And I want to preface this by saying, anybody listening, I can go through a pitch deck really pretty darn quickly because I've looked and worked on like literally thousands and thousands and thousands of them from both sides of the equation. I think that's important, not just from an investment standpoint. So I know what goes in on the founder side. Actually, that's like primarily most of my work is on that founder side, right? And I work heavily with founders on things like pitches and their decks. So I just want to preface the question with that so the audience knows like this may not be
Baseline for like everybody.
Investors think across the board on these things. So the first thing I do is I do a quicker skim through, and I do really look for that story. But the important thing is I talk a lot to founders about this, is the money story, the money slides. I think it's very easy for founders to try to get this story around what they're doing and the why in terms of the solution and the world and the customer set and that type of thing. And they miss or they downplay or they don't focus enough in their deck on that money piece. Because at the end of the day, the investors are going to write you out a check, not because you're saving the world. It's because you're going to give them return on their money. And I see this in actual pitches too. Founders who might have a 7-minute pitch, they'll go 5.5 minutes on the product and everything, jam in 30 seconds on the money and the return, and then, sort of close on T. I'm just giving an example. And it's, you haven't. So I think that's one thing is really, in addition to having a great story, is your money story in there too. And there are a bunch of different places in your deck that plays out, but I do think that's really important for founders. Like you got to give investors the reason to write the check out. I then, because of my background in sort of marketing operations, I personally, and this is just me personally, tend to look a little bit more maybe at the go-to-market. Is that well thought out? Not every investor does that. Every investor, and this is actually an interesting thing for folks if they can get inside the heads of the particular investors, looking at their background and understanding where they might look. But it's different. That's for me. Especially in early stage when you have less traction, I then also try to look at the logic that people are using for things like their roadmaps or their use of funds. So do they know the triggers inside their business that if they get this round of capital, they know where to put it. They know what to, right? To start to get that, right? We're all looking at that, Series A hockey stick growth. Do they really understand that pretty effectively? So there are a couple spots I kind of look for in there. And then I look a little bit at team, but that's one of those areas I try to be pretty open on for obvious reasons because of my background. I think it's really important, and unfortunately not all investors do this, but I think it's important to have a very open mind in terms of what that team might look like. That's where I will spend a lot more time after skimming the deck. So I frankly don't spend a ton of time on the team, but that is a personal thing. So those are a couple of the things when I kind of do like the first round, because that's the first step for a lot of founders is you're passing the deck on, you're not there, right? And so it's the investor looking at the deck. And so it's an important process. So those are a couple of the things. And then for me personally at Allison, our fund, we do need to have a level of excitement about the company. And usually what that means just for us is that it's going to be a positive add to the world in some way. So, so those are like a couple of the things on the first go around that I'll dive into.
Okay. So just going to add again, 2-part question. So I asked a lot of two-part question. I don't know, like I always have like two thoughts on every single thing. So thought number one is, so when I usually talk to VCs, and I happen to talk to like dozens and dozens of them, when they talk about team, so the first thing that they mention is they're looking for the right team. And the roughly translation of the right team is, if you're building next SpaceX, for example, do you have an experience in space tech? Have you worked in space technology before? If you're building, I don't know, like, VR, AR or something like that, like that's the hard thing today. If you're working in AI or something, have you done something in the previous role or something? Do you have an understanding? Talking to you kind of made me realize, like, okay, we should all, like, as an investor, as an emerging investor, first time investor, we should always have sort of an open mind. Like maybe somebody is going to prove you wrong. He does not have the background in space tech. He's probably built a PayPal before, but he does not have a space tech background, but he's going to build a really, really, really good company. What's your thought on, looking for founders that does not, check your traditional boxes, like, hey, you come from a XYZ background? So that's question number one. Question number two is, how big the check that you write, like what's the check size looks like? And how do you decide? And that's a question that I personally want to learn. Like, how do you do the portfolio construction? Like, okay, so I'm going to write 500K check, $500,000 check, $1 million check on an average. How do you do the portfolio construction as well?
So on the first question, this idea of founder market fit is, I think, a really interesting one.
Yeah.
And I appreciate the VC's perspective on having like a very clear connection to the problem. If someone comes from the industry, that's a very clear connection to the problem they're trying to solve. I do think it's important to broaden that, because there are a lot of ways that you can, number one, hit a problem. You could have felt it, for instance. I've seen a lot of solutions come up from, let's for instance, talk about the underbanked. There have been a lot of very successful founders who've never been in banking, but they've been in populations that have such little access to things like credit or bank accounts. And they said, I know what this does. I know what people need, and I'm going to figure out how to build it. At that point, it becomes, are you then building your team such that you can, as a team, build that product? So did you go out and find a technical co-founder or get a great engineering team or something to actually build your vision? We have a great portfolio company who the founder is building an AI-driven legal tech solution. She is not tech. She comes from the legal space. She's a lawyer. But what she did is she was, first of all, very well versed, and as a lawyer, kept herself very educated for years on the actual innovation side of it. And then she felt that problem. She knew it was happening. It was trademarking, AI-driven trademarking. She saw swaths of customers in front of her. She goes, oh my God, if you can just slot something in right here, all of my colleagues are going to eat this up. And so she went out and she found the right team to build it. She just closed her seed round and she's killing it. Like, she is selling like pancakes, and she's got, I don't even know, 1% churn because 1% churn in her customer base last year, because everyone's like, this is such a, so it's like really being, I think, more thoughtful on what is the relationship to that problem or solution. That's, I think, think about it. And then back to your previous question on then telling the stories, that becomes interesting for founders to really think about, how am I telling the story of my connection to this problem, right? Especially if they aren't maybe in the space. So that's like, it's and so that becomes, how well do they tell a story? To your second question on check size. So we have varying check sizes by stage. We tend to write out for seed and Series A. Well, I'll break down first before I get to check size. I would say the majority, not by much, maybe 60% of our investments are in seed stage. We have a decent handful in pre-seed. And then we kind of look at Series A a little bit what we call opportunistically. So it might be either follow on or it might be a Series A company from a great co-investor or something like that. For seed and Series A, we tend to write out 150 to 250K checks, roughly. And then pre-seed, the idea there is that obviously, and a lot of firms actually do this, the idea there is that with the increased risk, we tend to write out, I would say, 50 to, it's usually like 75 to 100. We've done a couple 50K checks into pre-seed with the idea that if they're doing well, we're going to add more in the next round. So we do usually invest into pre-seed with the intention of adding more, but just when it gets de-risked a little bit. So that's kind of how we break that down.
Oh, that makes sense. All right, awesome. So thank you, Kate, for just explaining and sharing all the knowledge. So we do have a decent big of an audience. I'm very fortunate to whoever listens to the podcast, reads the newsletter or whatever. So what we do is we just float out this small questionnaire like, hey, Kate is coming tomorrow. She's done amazing things. If you want to ask any particular question, please send us those questions. So I get all kind of questions, funniest one, craziest one, stupidest one, the best ones. So I try to pick the ones that are worth your time, worth everybody's listening to the time. But this time, I also want to add one personal question onto this list because I wish I had the opportunity. Okay. So here's the question, and there's a small preamble to that question. I met a founder yesterday, not gonna name her. She's amazing, building a very cool company in crypto. And I asked her like, hey, how can I help you? And she was like, so I'm raising $2 million first time, seed, no pre-seed, no nothing. The first money that I'm raising is $2 million. I'm like, okay, what you gonna do with that money? I'm gonna build this cool product. I was like, okay, and then what? Oh, so here are a few things that I want you to know about. I don't want to sell that company, like not today, not 10 years, not ever. Like I just want to keep running that company. And I also don't want to give a lot to the investors. I want to keep the majority to myself. So I want to rely on their money, but I'm not going to give them majority shares or like whatever. And I want to use their money to build my business and then just continue to run. I have a lot of red flags on that, but I want you to answer that because, I want you to answer that because I'm still a student. So yeah, please go ahead.
The way that I'm going to answer that is reminding the audience that investors invest for equity that's going to do something.
And a small thing, sorry to interrupt you. My closing statement was, as an investor, as an angel, or like whoever, like you're going to talk to, nobody cares about how cool your idea is. Nobody cares about that. Nobody cares about if you're going to build a profitable business or not, because profitable business can be a $5 million business. Profitable, you could be making good living, but that's not a VC-backable business. So stay away from VC. And so while you're answering that, please also mention this thing. What do you look for in a startup, and what are VC-backable businesses? Because I think we need to clear that out as well.
Great. So the way that I would start out answering this question is to remind everybody that investors specifically, right? We're not talking about philanthropists. We're talking about investors, specifically in this case, VC investors, which I would bunch angel investors in there as well. They might, don't need as much of a return, but everyone is going to be looking. They are writing your check out at the end of the day to get equity in a company that is going to give them a return, an exit, which then gives them a return on that money. That's it, right? You could tell a horrible story and somebody could think it's great. You could tell an excellent story, but that is the transaction that happens at the end of the day. There is literally no way to avoid that unless somebody comes in and simply isn't educated on what's happening in front of them, which is a whole other bag of worms. Don't do that. Don't mislead anybody, right? So this idea of VC backable company, and I want to be a little careful using fully VC backable because, again, you and I both know that VCs tend to look for a higher return profile, right? So, but this idea of returns really is important, and that breaks down into ownership stakes, right? And so So to this particular founder, I would remind them that things like your valuation are going to matter. If you are looking for $2 million, you've got an early stage company, but you don't want to give a lot of way, that math doesn't work unless you can prove out, if you only want to give 10% away, you have to show investors that you are then valued at $20 million. Right? It's so that the literal math isn't going to work out. You won't be able to convince people of that literal VC math to get that done. And then the second difficulty in this pitch to investors is that there's no exit. And so unless they're going to structure some sort of return that's uncommon to the VC space, something like K1 distributions if there's, but that ends up not being a VC investment, right? So it's just, I'm not seeing a lot of these pieces line up for this investment. Now, there are other types of investment that they could look at, but I don't think it's going to be VCs. It's not going to be a lot of angels in the space. It's going to be really, really hard to get that $2 million.
Totally agree to that. Thank you for explaining that. Okay. So the first question from the audience, second for the list, is how do you manage the deal flow? Assuming that you have a lot of founders in your communities and in your ecosystem. So how do you manage that?
It's a lot. So one of the good things that we had already had set up is that both my fund partner, Allison, and I have pre-existing programs and establishments and things that we can either assess companies on. So we have maybe an accelerator program or a grant funding program. All the companies get scored, right? So we can do some filtering there, and we have previous relationships we can act on. So we had some pre-established stuff that has allowed us to deal with our deal flow a little bit better. We do try to have open doors. So we do try to respond to every inbound that we get through our website, etc. We do pretty quick. And again, this is back to that deck that we talked about. We do a lot of that top of funnel. If there's a company that pitches us, we always and they don't have a deck, we always ask for a deck. So that's one of our first things. And we try to do a quick, it's usually no or maybe. At that point, no is sort of like, hey, we've been able to review for whatever reason, and we do try to give a reason. We also do try to provide people with other opportunities if we can. I always think that's like a good no. If you can give something else of value on that no.
Yeah.
And then the maybe is, this was interesting enough, we'd love to, can you send over a few more details and we'll do a review. We try to be pretty clear with our process as well. And I would be totally misleading people to say that we have responded to every single thing. But it's pretty close. We try really hard. And I think the nature of us also having multiple hats allows us to do some pretty good relationship management as well. So for example, I'm working with a particular accelerator program as a mentor EIR. I can manage that deal flow pretty well just through the relationship. So yeah, it can become, and we try to be really clear with co-investors what we're looking at. We get definitely deal flow through co-investors. So we try to be really clear on our buckets, for instance. So those are a couple of the ways that we manage it. We're working this summer on upgrading our CRM, which would include a bit of a fuller detail on that inbound and deal flow. I would say that's one area we do need to improve. For any new fund managers out there, for instance, like think about your CRM, I think a little earlier.
Yeah. It's a lot of work. And if you delay that, it becomes even more tedious in the later stages. So I totally agree with that.
Yep.
Okay, awesome.
Exactly.
So the next one is, it's a funny one. Everybody asks about AI. So what do you believe, how do you believe AI will change the venture capital and traditional decision making? That's a good one.
Well, first, I think it's going to be this little hot trend to start where a lot of people are going to probably be making bad decisions because it's hot. This happens in every hot market, right?
Yeah.
And every founder is going to pitch some, every founder is going to pitch some sort of AI thing. So investors are going to have to be really careful and that type of thing. Listen, there's no denying the fact that AI is going to be it is really important on this space, on the innovation space in general. It is going to increase. There's no sort of getting around it. I think for me, we try to be really thoughtful when someone says AI in front of us. What is it that they mean? What is the level of sophistication? We have to really look at things like, I don't want to bucket it quite like this, but what is the level of good versus harm? That, are they being thoughtful 5 years down the road on data usage? Are they building this with bias in mind? So it's like there's so many things right now that are going into AI that I think from both a founder's perspective and an investor's perspective, it's really worth it to take the time to be thoughtful about what people. I think 2 to 3 years ago, you could kind of get away with this sort of AI-driven X.
Yeah.
Because a lot of times, really, what that was an algorithm. Maybe there's some ML in there, but now that's really like AI is really expanded. So I think the industry, it's really going to be worth taking time on those investments. I'll also say that because it's a hot market right now, I was actually reading something just this morning on what we might see from last year and this year in terms of the investments into AI and what that means for some of the others. Is that going to actually detract capital from some of the other important spaces? I don't know. That's a little bit of a TBD, but I do believe it's going to make its mark on the industry, and it's just a matter of kind of what shakes out and the caliber of it. I always say to investors, like, careful of the FOMO, think about things, and this is good for founders too. Think about things like your moat. Like if you just have something wrapped around ChatGPT.
Yeah. Think about that.
And I ask you about your competitor set and what's preventing somebody from, it's like that time of thought. You really got to think through it. So
the funniest one gonna be is when you ask somebody who's building on top of ChatGPT's LLMs or something like that, and you ask them, what's your competitor? And they go, oh, we don't have any competitor. That's the funniest one.
Yeah. Oh, listen. Yes, dear founders, don't ever say you don't have any competitors. That is a red flag for an investor.
Yeah. And
yes.
And people like I think that there's sorry to digress, but I think there's this notion out there that probably have come from like the blue ocean strategy. That kind of a thing is just like, hey, if you don't have a competition, that's like the thing everybody's chasing. No, I don't think so. Like everybody's chasing an industry that does not have any competition, players, potential acquirers, X, Y, and Z, because it gets more riskier that way, right?
It does, and it takes, there's only a certain subset of investors that have the fortitude to take that risk. The real, like, early adopt, like when we're talking about like space, right?
Exactly.
There's only, that's like an extreme example, but there's only a certain subset of investors that can truly go into like the just about untapped markets and like feel great about it.
And then you need to have a lot of cash as well to make waves into that market, because it's a very catchy thing. Okay.
Yes.
Okay. Awesome. So the last one on the list is for the startups at pre-seed and seed stages, what you primarily work on
Yep.
at Workplace. What matrices or milestones should they focus on to attract venture capital investment?
This is a good question, and it's a question that's really interesting this year. Because what's happened is any founder out there who was trying to fundraise last year knows that it was horrible. And the goalposts have changed with investors. So the things, as an example, if you are a B2C focused company, 2 to 3 years ago, you could get away with going into seed stage with a lot of users, and you may not have necessarily turned on the revenue channels yet, right? It was just the number of users was going to be okay. Now you've got investors at seed stage who want to see a pretty clear and usually quicker pathway to revenues, probably that you have tested that, etc. So I'll try to answer this a little bit more generally. So right now in pre-seed, the companies that have their product, let me clarify this on tech. I'm going to say tech companies. The companies that have their product a little bit further down the road and more developed are more attractive to pre-seed investors. And if they have at least betaed and they have something really good and tangible on that user side. So whether it's B2C or B2B, investors are wanting to see a little bit more on kind of both those marks. Again, really thinking on that pathway to profitability. They are also expecting that the fundraise is going to cover at least 12 to 18 months. You could get away at pre-seed before, maybe a little less, or maybe just sort of closer to 12, you'd be okay. But just because the fundraising environment has been so difficult, they want to see that capital. And really wanting to see rounds filled out before writing out checks. I still think it's okay at pre-seed that you don't always have a lead. I always tell pre-seed founders, this stage is the one that you don't necessarily have to be chasing a lead. You need to be chasing capital momentum. That's really the thing. So I still think that's the case. And then pre-seed rounds is still where we're seeing a lot of angels. So a lot of angel activity. It's still depressed angel activity, but that's where angels are playing. So founders understanding the angel environment, I think, is a really good move at pre-seed in general. What I try to say to folks in pre-seed is that things like I'll actually move into seed stage. Seed stage is the stage, traditionally speaking, where you are figuring out things like your product market fit, your unit economics, your pricing structure, your that type of thing. I still think that's the case. Investors like to see it a little bit more tangible and maybe a little bit if you're going into your seed pre-seed or your seed fundraise, they like to see things that are maybe you've experimented a little bit more, you've tested out pricing, that type of thing. I still think you do not need to have it figured out. Seed investors now are, I'm not going to say requiring, but do they really have that revenue conversation pretty heavily where they didn't used to, right? And I've heard a couple of investors who are sort of like, well, I need to see, a couple 100,000 ARR to invest at seed stage. And I'm like, gee, I think that's sort of on one end of the spectrum, but there are definitely some investors right now at seed stage that are like, sorry, we got to see you pumping. And that used to be closer to Series A. So I think those are a couple of the things right now. Again, same goes for seed stage. If you can position it that you're going to be going out for, 18 and get 18 months of runway, that's making investors feel a lot better. And it's just taking a little bit it's just taking longer, right? You're not seeing fast rounds anymore. I am seeing a lot of people too, and I think this is going to decrease this year. Saw a ton of it last year though, where folks going out what they had intended to be a larger priced round, they have shifted towards smaller bridge rounds. A lot of bridge rounds out there. And if you can tell that story, it's not a horrible idea. You just have to really plan it out well so that you're getting, there are a lot of investors that don't love bridge rounds. So if you can tell that story well and you've got a good, you've got a good pathway in front of you, I am seeing a lot more bridge rounds. Definitely in the past year. That'll probably continue this year. I'm going to use the word thawing. I think that the market is thawing right now. We had a portfolio company that was raising for at least half of last year. They closed in last month. And it was it was like sort of January, and then things are moving, but I'm both for VCs and angels, but I think I'm still going to use sort of like thawing. So those are a couple, those are a couple of things, but it's not a, seed stage. It's not like you've got to have $1 million ARR or anything like that, but focusing on what, traditionally speaking, what happens is your seed stage is kind of where you get a lot of those kinks, the big kinks, what I mentioned, product market fit, pricing structure, whatever, so that when you get your Series A funding, and again, you're always going to be refining, growing, changing, but when you get your Series A funding, the idea is that Series A, you can put the gas on and you've got the things functioning that you start to get that, So that's kind of, traditionally speaking, the goal of your seed stage. We've got a lot of this figured out, and we can put that gas in.
Okay.
With our Series A.
Awesome. Thank you, Kate, for answering all of these questions. So we do have one ritual on the podcast. So what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. How much time do you spend on social media these days?
Okay, I have this very mixed relationship with social media. I sometimes waste time on things like sort of perusing and getting distracted on things like Instagram or something. That portion I'm trying to decrease. I literally throw my phone in a drawer for, I'm going to say, much of the day. And I'm trying to do things like, put it away at night and that sort of thing. So I am working on this sort of distraction piece. I will say that one area I am trying to, it tires me out are things like hopping on LinkedIn and being a voice. I need to switch it, and I need to think about where I can be a voice that's effective and value add, and not just this sort of distraction. So that's what I'm shifting right now. The idea of hopping on LinkedIn right now and making a statement or something is tires me out. So
or maybe Twitter. You can just go and ramble on Twitter and complain about VC and every single thing. So because VC Twitter is paying these.
Exactly. Exactly.
Awesome. Question for the next guest, please.
I'm going to try to use something practical because it's a question that I hear a lot from founders. I would love to know what are 2 or 3 things that you have found very valuable for time management.
Okay.
And that could be meetings or your day or whatever. But so many people are just I have a pile in front of me. I don't know what to do with it. How do I structure it? So I love the meaty walk away question. So I would love to hear that.
Awesome. Thank you. Thank you so much for that. Thank you so much, Kate. Lovely talking to you. I appreciate all the wisdom.
What a good conversation.
I'm so happy that you had a fun time.